Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. We're going to devote this episode to diversification. It is working this year. We're recording this on March 30th, one trading day left to the quarter, but I think it's okay to do an update with one day left to show how diversification is working. We're also going to look at the yield on the 10-year Treasury. Those are two important charts right now. First up, diversification. Bar chart here. First bar. What if you had a portfolio that was 100% invested in the Magnificent Seven stocks? This is an ETF that does that for you. Ticker symbol MAGS. It equal weights those stocks. Well, that ETF is down 15.42% this year. So not a very good return. Those stocks which have been carrying the U.S. stock market for a number of years now are finally faltering. That leads us to the second bar in this chart. What if you had a portfolio invested 100% in U.S. stocks, but in a broad index like the S&P 500? Well, you're down 4.81% this year. That's a lot better than being down 15%, but it's still a meaningfully negative number. Now, third bar, let's say you're invested 100% in stocks, but instead of U.S. stocks, global stocks or the world stock market. We're using the MSCI All Country World Index here. In that case, you're down 1.01%. Still down, but much less meaningfully. Now, let's say you've got a classic 60-40 portfolio, 60% stocks, 40% bonds, and the stocks are global stocks and the bonds are just plain U.S. bonds, Bloomberg U.S. Aggregate. In that case, you're up 0.41%, not a meaningful return, not keeping up with inflation likely, but you're still up nominally. You're still in positive territory. Last bar on the bottom, this is a portfolio of 60% stocks, global stocks, 35% U.S. bonds, and 5% gold. In that case, you're up 1.15% for the year. That may, if that continues, help you keep up with inflation. So for gold, by the way, we're using the iShares Gold Trust, ticker symbol IAU. And so we've created a bunch of portfolios here to show you that diversification is working. Getting away from U.S. stocks is working. Adding bonds is working, and adding gold is working. So no guarantees whether that will keep up, but diversification is working. Next slide, I think, is an important one to show now. This is the yield on the U.S. 10-year Treasury note for the last 5 years. What does that mean? That means if you have bought a 10-year U.S. Treasury note or loaned your money to the U.S. government for a 10-year time period, this is what your yield has been at various different times over the last 5 years. So all the way to the left is 5 years ago, right as COVID started, the end of March 2020. You can see the yield on this was less than 1%. So if you loaned your money to the U.S. government for 10 years, then you locked in a less than 1% yield. That's terrible for you, terrible for an investor, but great for the U.S. government. Shift your eyes all the way to the right now, which this chart doesn't actually end on Friday. It ends on Thursday when the yield was 4.38. So if you bought a 10-year U.S. Treasury note, you loaned your money to the U.S. government for 10 years last Thursday, a few days ago, you locked in a 4.3% annual yield. That's a lot better for you as an investor, a lot worse for the government because it has to pay a lot more on the money it's borrowing. So Donald Trump is, of course, very conscious of this. Really, to be fair, everybody is very conscious of this now. I think we mentioned in our last podcast that Neil Ferguson wrote an article for the Wall Street Journal arguing that when a great power's interest payments exceed its defense spending, that's the telltale sign of decline. So everybody's worried about $36 trillion in debt we have and the interest we have to pay on it. This 10-year Treasury note or 10-year loan to the U.S. government is significant in other ways as well. It's the benchmark rate in some sense, which means mortgage rates are keyed off of it. auto loan rates key off of it. A whole bunch of rates kind of organize themselves around this. So it pays to be cognizant or conscious of what the 10-year Treasury note is yielding. And this chart shows it at 4.38. I think it closed down in the 4.2% range on Friday. So diversification is working. Bond yields are up, but I think it's fair to say Donald Trump is trying to keep them under control. As investors, we want them to be higher. As citizens, we want them to be lower. So there's a bit of a conflict there. But that's the news for this episode. This is John Comarianos for Capital Considered, signing off. Thank you for watching.